you've hit 70 and a half. You like to give to charities and others. Let me show you a way that you can save a lot of money on your taxes and still give to charities. It's called Qualified Charitable Distributions. Let's get into it. Hi, I'm Dave Lopez.
And I'm Chase Lopez, and we're financial advisors with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. Now, Dave, before we jump in, just want to remind everyone, please go ahead and hit that like and subscribe button down below. Also, make sure you click the bell to make sure that you're notified for any future videos. So, you said it off the top, Qualified Charitable Distributions, or QCDs. So what is, I should say, a QCD? So what a QCD is essentially what you're doing is, A, you have to be above 70 and a half in order to do it, right? So that's the first thing. Second is, this is money that's going to go directly from your IRA, your individual retirement account. Remember, we've done videos in the past on IRAs, but you got the tax deduction up front on that contribution to the IRA.
You never paid taxes on it.
Didn't pay taxes on it. It goes into the account. It has grown. Now, what you can do with this qualified charitable distribution is have that money sent directly from that IRA to a qualified 501c3. That's the phrase, right? 501c3 charity. And you don't have to pay any taxes on that money as it goes from the IRA to the qualified charity.
Yeah, and I want to jump in there just as a preface to say this strategy and several other charitable donation strategies are wonderful for saving tax dollars, but you only really save if you were going to give the money anyway.
Yes.
Right. So this is really just for people who already have in their plan to give to their church or give to any cause, and that's part of their retirement plan, right? To give to others, and we applaud that. What we're going to show you, if you're going to give to others anyway, let's maximize the savings on it. And that enables you to either give more to charities, or give the same amount you were going to give and have more money in your pocket. And that's where this becomes a wonderful treat.
Absolutely.
Okay, so we talked about kind of what it is. Let's talk about why it matters. It allows you to reduce your taxable income. Okay, so that write-off is going to save you on taxes. Okay. Specifically, it's an advantage if you fall into the category, and many people do right now, retiring, where you don't itemize your deductions. So if you itemize your deductions and you give $10,000 to charity, you get to deduct the $10,000. It's one of your deductions. But if you take the standard deduction, married couples about $31,500. Okay, and
which most people do, by the way.
And most people do. Yeah, thank you. So, and then you give $10,000 to the church, but the $10,000 you give to the church and your other deductions don't equal $31,500.
Right.
You could argue, and I would argue, that you don't get to deduct the charitable deduction because you get that $31,500 standard deduction, whether you do the charity or not. This allows you to get the deduction on the charity and the standard deduction. So I'm not going to go into the details of it, but you would hit on it because we just don't count it as income. And the third thing is it lowers your adjusted gross income and your taxes. It may actually lower the amount you have to pay for Medicare Part B. That's called IRMA. That's for another video. But it can save more than just income tax. It can also save Medicare surcharge tax as well.
Another name for this type of advantage, I guess you could say, tax advantage, is this is a above the line deduction, right? So before you calculate your deductions, before you do any of that, this just comes out before any of that is calculated.
So it doesn't even show up as income. So if you have $150,000 in income, then they immediately drop off this $10,000 qualified charitable distribution. So now it shows, what did I say, 100,000? So now it just shows your income is 90. That's before you start taking your deductions. Thank you, Chase.
And just to jump in right there, Dave, this is a great tax planning tool, right? Things like Roth conversions, required minimum distributions, all things that you have to be cognizant of. We've done videos on both of those. But this QCD strategy can help with those. So get with your financial professional to see exactly how it would help your situation. But it will help in those tax factors as well.
And there's limits. So we already talked, one limit is you can't do it until you're 70 and a half.
Correct.
Now that's really interesting because for most of you listening that Your RMDs, your required minimum distributions, don't start until 73 or as late as 75 if you were born 1960 or later. It's interesting. This allows you to start doing this before. So you can kind of jump the gun and start reducing your IRA balance, which will in the future reduce future RMD requirements if you're going to give anyway. So you can start at 70 and a half, but there are limits. The limits are $108,000 in a given year per person. And if you're married, 216, double it, is the most as a couple that you can give in a given year.
Both have to have IRAs.
Yes.
Right. That's important.
Yes.
Right.
From each.
Yes.
Yeah.
Yes. Yep. So that's the limits. There are other strategies as well. Charitable remainder trust, charitable gift annuity, that have some other special tax benefits out of the scope of the video today, but something you may want to get with your financial professional about to see if that can also help with your charitable giving writ large.
Yeah.
Some key rules to remember just about this whole QCD strategy that we just talked about. This money must be coming from a traditional IRA. Can't be a 401k, can't be a Roth IRA. I'm not sure why you would want to do it with a Roth IRA anyways.
You would not, right?
Right.
Don't give your Roth money to charity.
Right.
Give
So
money to charity.
that's the first. The second is it has to be a direct transfer. It has to go straight from your IRA to the charity. Most custodians that hold IRAs allow you to do that. You cannot do it to a private foundation, to a donor advised fund or something like that. It has to be a 501c3 organization. And then the last one you touched on is you have to be 70 and a half.
Yeah. And for reporting, just so you can, if you do it and you want to make sure it was done right, you'll get a 1099 for your distribution from your IRA. It will have code Y for yellow in box 7. That's what identifies it as an above the line tax-free distribution, right?
Great. So now, QCDs, great way to save taxes in retirement. Thanks for joining us for another episode of Retire Your Way with ILG Financial. Please don't forget to hit the like and subscribe button down below for future videos.
Hi, Dave Lopez here. I want to thank you for watching our ILG Financial video series, Retire Your Way with ILG Financial. Just wanted to remind you, in addition to our YouTube video series, we also offer podcasts, 30-minute podcasts on different topics. You can check them out through our YouTube channel. You can also look at them through our website or any of the below listed platforms. Talk to you soon.